Good day, and welcome to the DoubleLine Smart Beta Webcast. Today's conference is being recorded. At this time, I'd like to turn the conference over to Corey Clearmont, Product Specialist. Please go ahead.
Good afternoon. My name is Corey Clearmont, Product Specialist at DoubleLine Capital, and welcome to the DoubleLine Smart Beta Webcast titled What's the 411, hosted by our Deputy Chief Investment Officer, Jeffrey Sherman, and Portfolio Manager, Sam Lau. Some notable upcoming webcasts here on the left-hand side. You'll see on April 25th, we are going to be hosting the International Fixed Income webcast. And then on May 9th, we're going to be joined by portfolio managers Ken Shinoda, as well as Morris Chen to discuss the Income Fund. If you'd like to register for these webcasts, please visit doubleline.com to do so. Outside of webcasts, you'll see here on this slide some other thought leadership that we have to offer here at DoubleLine, including our own video series titled DoubleLine's Channel 11, hosted by portfolio manager Ken Shinoda. And then below that, you'll see two podcasts that we have to offer. The Sherman Show podcast, hosted by today's webcast host, Jeffrey Sherman, as well as Sam Lau. And then Monday Morning Minutes podcast, which is a weekly podcast hosted by portfolio manager Sam Lau and Jeff Mayberry. Again, weekly, that touches on timely market content over the past week. And then the newest thought leadership piece to our program is the PS Perspectives, which is hosted by our team, the Product Specialist team, where we release a short video about 10 minutes every month talking about DoubleLine's latest thoughts on the financial markets. Now, during today's webcast, we're going to discuss four strategies. Starting up in the top left-hand corner, you will see the DoubleLine Multi-Asset Trend Fund. Now, we do offer two different share classes at DoubleLine, both the institutional or iShare and the retail share class or N-share. And below each of those, you will see the minimum investment amount as well as the expense ratios. On the right-hand side, in the upper right-hand corner, you'll see the DoubleLine Shiller Enhanced CAPE Mutual Fund. This is the longest standing member of the Smart Beta family. And again, you'll see minimum investment amounts as well as expense ratios below each share class, the iShare and the N-share. In the bottom left-hand corner, you will see the Shiller Enhanced International CAPE Mutual Fund. Again, two share classes here, both institutional and retail, followed by the minimum investment amounts as well as expense ratios. And then the newest strategy to the Smart Beta family is going to be the DoubleLine Shiller CAPE U.S. Equities ETF. We actually just celebrated its one-year anniversary a few weeks ago, and its ticker symbol is CAPE and has a gross expense ratio of 65 basis points. One thing to note is last week we did launch two new ETFs that we are very excited about here. The DoubleLine Mortgage ETF, ticker DMBS, and the DoubleLine Commercial Real Estate ETF, ticker DCMB. Now, while not the focus of today's webcast, DMBS, the mortgage ETF, does focus primarily on residential mortgage-backed securities, allocating between non-agency as well as agency mortgage-backed securities, whereas DCMB, the commercial real estate ETF, focuses on high-quality commercial mortgage-backed securities, investing in securities with a credit quality rating between AAA and single A minus. Now back to the funds that we're going to be covering during today's webcast. And these next four slides are just going to be touching on performance. And I do want to mention that all of the performance figures that you see on these next four slides, it's going to be through March 31st of this year. So starting with the Multi-Asset Trend Fund, you'll see that the fund has had a relatively good start versus its benchmark on a year-to-date basis. The institutional share class has outperformed its benchmark by 233 basis points, while the retail share class has outperformed its benchmark by 239 basis points. And again, that is year to date. Moving on to the CAPE ETF. The CAPE ETF has also got off to a great start this year. It has outperformed its benchmark, the S&P 500 index, by 40 basis points with a return of 7.9% versus the S&P index return of 7.5%. And again, that's through the first 3 months of this year. Next, looking at the DoubleLine Shiller Enhanced CAPE Mutual Fund, looking at the institutional share class DSEEX. We launched this fund back on Halloween of 2013, and the average annualized performance since inception, a return of 12.02%, which has outperformed its benchmark, the S&P 500 index return of 11.56%. So an average annualized outperformance over the same time period of 46 basis points. And lastly, we have the DoubleLine Shiller Enhanced International CAPE, looking at the institutional share class again, DSEUX. It has had an average annualized return since inception of 7.55%, which has outperformed its benchmark, the MSCI Europe net total return US dollar index return of 7.14% over that same time frame. So an average annualized outperformance of 41 basis points. And with that, it's my pleasure to turn over the webcast to our Deputy Chief Investment Officer, Jeffrey Sherman.
All right, Corey, thanks for the introduction here. And thanks everyone for joining us today on April 11th, 2023. And so in honor of it being April 11th, we thought we'd dust off one of the classic R&B albums out there for Mary J. Blige and bring it and say, what's the 411? And so it's one of the classic albums out there too. I think that's what anointed Mary J. Blige as being the queen of hip hop and soul together with that seminal piece that she put out there. So definitely a classic as we were putting this together. Sam and I put a few tracks of this on as well to think about it. But also for our younger folks out there that didn't remember, as we were talking to Corey about this as well, 411, it's a symbolism for information. And we used to do this before the Google. You had to actually dial 411 to get information. You could get phone numbers and the like. And again, maybe that's a little archaic to talk about people's actual phone numbers. But anyway, wanted to update everyone on the information on where we are in the smart beta space today. And so we're going to cover 3 of our funds today. I want to start with the multi-asset trend fund. One that tries to exploit things within the trend following nature within different segments of the market. We're going to talk about our equity products as well. I'm going to turn it over to Sam so he can cover both the ETF on the CAPE product as well as the 2 mutual funds, one covering the U.S. and one covering the European and international markets as well. So I'm going to start kicking this off by talking about the structure that we're using for the 3 mutual fund products. The ETF is a little bit unique and different with what it does there. But again, talking about this multi-asset trend fund to start today. And so for those of you who've been listening to us for a while and familiar with the structure we use, we run these portfolios, what we call an overlay strategy. And so for money that gets invested into these mutual funds, what we do is we take those proceeds and put them in a high quality, low duration, low interest rate sensitivity product within the fixed income space. With that portfolio has the objective of trying to outperform cash through a cycle. Obviously, last year was a very difficult environment using fixed income instruments to try to outperform cash. But again, through a full cycle, the team has been able to demonstrate that. As we said, in these types of products, it's very difficult when you have a rising rate environment, especially the one we saw last year. But not here to make excuses, just to talk about the way this looks on a go-forward basis. And so those fixed income portfolios then serve as collateral so we can do the other part of investing in these portfolios. And so with the multi-asset trend fund, what we're doing is getting access to roughly 60 markets out there, various parts of the equity market, the fixed income credit markets, also commodities and currencies, and being able to go long and short those exposures based upon what signals we're getting from the trend and momentum within those marketplaces. And so again, it's a fixed income portfolio, serves as collateral. For every dollar of exposure that comes into the portfolio, we go and get $1 of exposure to this BMP multi-asset trend index, as you can see as the graphic depicts on this side. And so the same thing is done for the mutual fund on the DoubleLine Shiller Enhanced CAPE, high quality, low duration, low interest rate sensitivity portfolio, high credit quality portfolio serves as collateral. And then we simultaneously get a similar exposure, but instead of using this BMP multi-asset trend index, we're getting exposure to the Shiller Barclays CAPE U.S. sector total return index. And so, again, very similar types of ideas within the structure. The bond portfolios are there to serve as collateral. We also expect them through a full cycle to hopefully outperform cash. If they do, that becomes accretive to the overall structure of the overall strategy. And then lastly, with the international strategy, we do the same thing, same type of bond portfolio. The difference is now you get exposure to the Shiller Barclays CAPE Europe Sector Net Total Return Index out there as well. So again, the key difference here is the exposure you're getting, or the beta or the sensitivity of the market that you're getting from these overlays out there. But it's still the same DoubleLine team, same type of portfolios that serve as collateral there. So I want to talk first about the multi-asset trend fund, one of our newer offerings. We've been running this for a little over 2 years now. And the idea behind multi-asset trend is that you're trying to exploit the concept of momentum. And so if you go back and you think about momentum, one way of thinking about this is like factor analysis. And what the academic construct is that you want to look at securities within some cohort. In this instance, we're looking at the U.S. equity market. And you go here and you take the securities which have been exhibiting the strongest momentum, that is the greatest total return over some period of time. Usually it's defined to be roughly a 12-month period. And then you also simultaneously short the ones that exhibit the worst momentum. And so that somewhat neutralizes the market. It's not exactly precise in doing that. In some instances, you want to neutralize the beta to get the exposure. But in general, what this shows you is that over long periods of time, that momentum seems to be a pervasive exposure that you want to try to exploit within the marketplace. And you can see there's periods where, especially after strong runs, that there's reversals, right? If you think about the most recent one being, kind of early in that 2009 experience where the market really got where the negative momentum stocks did very poorly, then all of a sudden we got this big reversal. And so the ones that did the worst tend to be very good performers as well. So you can see some of the challenge that momentum has had over the last year or so, just again, as we had this directional market and we got that reversal as well. But this is not a phenomenon that's only within the equity market. And we credit the researchers at Applied Quantitative Research, or AQR, with sharing these data sets and making them publicly available. But you can actually see it. This is pervasive across many different types of asset classes out there. And so, again, not to try to get hung up in the details here, but we're trying to illustrate here is that there seems to be not just trend flying within the equity market, but also in not just in the U.S. equity market, but in non-U.S. markets, within fixed income markets, within commodities and currencies as well. And so understanding that academic backdrop, it allows you to kind of think about how can I put this together in a portfolio context. And so as we set out at the onset, the idea here is to generate two sources of return. The first one is to try to get access to this momentum phenomenon, and that's what's called the multi-asset trend product here. And again, this is something that DoubleLine worked in concert with BNP to help create. BNP has a long-standing history of exposure within this trend following space. And what we did was we worked with them to make sure it's much more tradable in the US, a little bit more liquidity with the types of vehicles we're using, and trying to trade some of the more esoteric markets as well. So again, thinking about optimizing that portfolio structure for delivering that in a daily liquidity vehicle. And simultaneously, as we mentioned, the DoubleLine team with their fixed income expertise is going to try to run a short duration, high credit quality portfolio with the objective of trying to outperform cash through a cycle. And so by combining these two exposures, we think that we can help deliver a better solution to the end client. Again, this is the graph I showed you at the beginning. So let's talk about what the multi-asset trend index that BNP created, what it allows you to do. And so I said there's roughly 60 markets out there. It's specifically actually 58 different markets. And if you look at what we have on the graphic on the screen, you can see that 19 of them are various equity markets. So they span the globe. So it's not just a U.S. centric or just U.S. large cap, but there's small cap in there. There's various North American exposures through the Toronto Stock Exchange. We have a lot of European markets, and we also have Asian markets as well, including some of the emerging market regions as well. Next, there's going to be interest rates in here. So not just looking at U.S. interest rates, but rates globally. These are done in the developed markets as well. So they can take, remember, this is not just being long only, but you can have long and short positions across this. So sometimes you're making curve bets in different areas of the market. But again, it's all driven by the trend that's underway within these marketplaces. Also, credit is another exposure. Again, this is trying to find exposure in the developed market world here. So this is both corporate, this is purely corporate credit, so investment grade or high yield. There's the FX, it says Forex on the screen, but you can think about these as various exchange rate pairs relative to the dollar. So these are the major tradable pairs of currencies out there. And then lastly, various parts of the commodity market as well. Again, these are the most liquid contracts within the commodity space as well. And so what you can see here is that what's going to happen within these various markets, you're going to look at the underlying trend for each of these single 58 markets. And so again, if you download the data or you reach out to fundinfo@doubleline.com, we can provide you with kind of the underlying data sets. You can see here what various markets that you're trying to go after. And so within these areas, you also have a minimum and maximum weight or amount of exposure you can do. So what will happen to this process is that there's a return forecast generated. You have these constraints in here with how much you can have exposure in there, and you're going to target an overall volatility. And so the process of this, and this is done every single day because you're trying to capture changes in the trend. So you don't have stale data where you're waiting a month or a certain period of time. You're constantly reassessing what's in the marketplace, and you assign what's called a penalty function to say whether or not you want to actually make that shift or not. So just because an optimization routine, it may shift the portfolio in a meaningful manner due to sensitivity in the inputs, you want to make sure that you're not just unnecessarily trading as well. So at a very simplistic level, what happens here is that you analyze where the current trend is in the marketplace. And so you look of each of these 58 markets over the last 252 trading days, or think of it as one calendar year. And you say not just what is the underlying trend, but where is the data point today in that market relative to each of those 252 days. And so if you have something that it dominates all 252 days, that's an extremely strong signal. If you have something that is underperforming for the last, that's an extremely strong signal, but on a negative side as well. So instead of just doing what a traditional kind of long-short manager would do and split that universe in half and say, well, if 60% of my observations are below, I want to be short, and if 40% are there, what you do is you kind of adjust that based on, one, the volatility, but secondly, you understand that these markets have an inherent long bias. And so instead of using the threshold to think about it as kind of a 50-50, because in general, markets tend to go up about 2/3 of the time, what you're going to use as a threshold for thinking about it is the bottom 1/3 is where you want to short, and the upper 2/3 is where you want to be longer. And you adjust the strength of that signal based on how strong that is within that range, whether you want to be long or short. Everything is done on a volatility adjusted basis. And so that's the inputs that you use to throw into your optimization routine. There's some small adjustments around there, as I said, for liquidity and penalties of trading, so you don't overtrade trade these signals as well. But ultimately, what you do is you throw this in there and try to find the optimal portfolio. And then that portfolio is scaled to make sure that it has a targeted volatility of roughly 8%. And so again, this is a routine that is followed on a consistent basis. I know it sounds very complex by nature, but ultimately what you're trying to do is generate something that gives you a strong signal for the overall markets, but it tends to be uncorrelated with actually the overall marketplace out there. And that's what you've seen from these type of strategies. And so again, we feel that this is a very strong strategy throughout a full cycle. It doesn't have the exact same, like that symmetry I was talking about, that, you know, if 49% of the observations are there, you want to be short. The threshold for actually shorting is that you want to be in the bottom tercile, not under the median as well. So again, there's a slight nuance there. It gives you a little bit different signals, but we think through a full cycle, that's a better way to approach this marketplace. And so you can see here that there's periods where the portfolio is extremely long. Almost every single market you want to be long. There's periods such as post-pandemic where the portfolio is telling you to be short almost every single market out there. And again, you can see the power of this signal as you go through time. And so there's an evolution over time. On average, you get about a net exposure of roughly 79% or so, but but that net exposure can be a 200% long versus 100% short. So ultimately, what you're trying to do is find a portfolio that will deliver that roughly 8% volatility target, again, subject to all this kind of optimization. And so you can see here, if you look at how this strategy performs, it's the blue line. This is the blue line is the fund itself. So this is the index plus the collateral portfolio. And you can see that you had very strong performance, from the launch of the strategy. You had some downward drift. You had some nice recovery during the pandemic. And then there were some challenges late in last year, right? Late in last year where the market really started to take off and recover. Those inflection points tend to really be a little bit of a struggle for some of the trend following strategies. And that's exactly what you see here. But the goal, as you see, is to do much better than kind of the broad-based markets out there during times of crisis. So it's thought of as a diversifying type of strategy that can help complement overall portfolio allocations. Within the fixed income portfolio, you can see here we've been active in shifting this around, but this is a high quality portfolio. It does, if you look at the exposure in there, we do have some bank loans in them, that floating rate exposure. Again, given the environment we were in last year, we thought was prudent to have in there, but also some of the higher quality structures that we have within the securitized space as well. Notice too, treasuries are in there. These are more shorter duration treasuries than what you'd find in like an index fund or within things like our core fixed income fund. But ultimately, the idea here is through time, we're going to navigate this to try to outperform cash. And you can see today what this portfolio looks like. Very similar allocations. We still have a meaningful allocation within the floating rate part of the market. This is as of the quarter end. Whether that's the CLO market, the bank loan market, in aggregate, that's about 30% or 28% of the fund today. We do have a little bit of cash in there as we've been deploying that. Cash is a pretty nice yielding asset, as I'm sure you're all aware today. I think a lot of people became more aware of that during this banking crisis, that cash actually has a pretty meaningful yield, especially if you don't leave it in your generic savings account at the bank. But ultimately, what you see here is, again, the credit quality is on the higher end of the spectrum. And again, from a full cycle, we believe that this is a strategy that can really help do that. And introducing trend following to an overall portfolio can help be a nice portfolio diversifier, especially in very tumultuous times. And so with that, let me transition it over to Sam. Sam and I have been recording all week together. We just did a podcast yesterday. So Sam, let me turn it over to you to give them a little hey treatment here on the various CAPE strategies.
All right. Well, thanks, Sherman, for that intro. And hey to everyone. Thanks for jumping onto this webcast and learning a little bit about our funds here. As you can tell, Sherman and I are old hands at this. We even have coordinated matching outfits so we can be twins on these video recorded podcasts as well as webcasts there. And as Corey had mentioned in the outset of the webcast today, CAPE had just celebrated its 1-year anniversary of our launch in to be specific, I should say, DoubleLine Shiller CAPE U.S. Equities ETF, which you see on the screen here. So happy birthday, somewhat belatedly, to CAPE. And the CAPE ETF itself is a uniquely actively managed sector rotation ETF that puts or provides, I guess you could say, investors exposure to the 4 cheapest sectors of the U.S. large cap equity market. And as the name suggests, it's based on the foundation of Professor Robert Shiller's CAPE ratio, which is a widely acclaimed valuation metric. I mean, the name itself is an acronym for cyclically adjusted price earnings. And while the CAPE ratio is considered to be one of the better predictors of equity market returns over the longer term, it was never really meant to be a near-term timing or investment signal on a short-term basis. So you can see this in the chart on the bottom left side of your screen here. And here we have the CAPE ratio for the technology sector in dark gray versus the CAPE ratio for the utility sector in the blue there, but they're both plotted over time. And from this, if you were to look at just the CAPE ratio to serve as this kind of investment or timing signal, you would have been allocated to utilities over technology all the way from where you can see it go back to on the screen to 2002 until pretty much now, because technology is a growth sector and as a growth sector, it commands a higher multiple. And thus, from this kind of simplistic view, it would always look expensive to the utility sector. But now that we have the benefit of hindsight, we know that eschewing this tech sector for utilities over the past 2 decades would have led to a pretty relatively poor performance. And so to be useful as an investment tool, a modification to the original CAPE ratio is needed. And this is where the relative CAPE comes in. You can see the formula here in the middle of the page. It's a modification to the Shiller's original CAPE ratio, whereby you divide each sector's, in this case, their current CAPE ratio by its historical average CAPE ratio. And for the use within the CAPE ETF, it's a 20-year average of CAPE ratio that's in the denominator. And when you take a look at that resulting ratio, if it's north of 1, that implies that the sector that you're looking at and applying that relative CAPE ratio to is overvalued compared to its own history. And conversely, if you have a relative CAPE ratio that's less than 1, that means it's cheap to its average. This is a process to normalize these sectors, and just normalizing it allows them to be compared against one another as a relative valuation mechanism. So you can see that here on the chart at the bottom right of the slide. It illustrates this concept where, again, you have the utilities in the blue line and tech in the gray. But this time, when we look at the relative CAPE ratios applied over time, you can see that after normalizing these valuations, you can see that there are times where tech looks cheap to utilities, and there are times where tech looks rich to utilities. So with that, you get that framework to trade and invest based on this unique valuation mechanism developed by both Professor Robert Shiller alongside Barclays Capital there in this highly stylized 2-sector example here. So thankfully, the relative CAPE ratio can be applied across sectors and to a broader universe than just those 2 that I showed before. So here on the right-hand side, you can see that for the CAPE ETF, it's applied to 11 sectors that correspond to the S&P 500. And those are shown, right there. But I would say that aside from just sectors, you can also apply it to broader indices. You can also apply that to security level. So it's a very robust measure and process as long as you have enough data for it. And this process is the one that we follow, and it's shown on the left-hand side of the screen. Again, this part here was developed by Professor Shiller, again, in conjunction with Barclays there. So the first step 1, the relative CAPE ratio is calculated on each of the 11 sectors that you see there on the right. Step 2, the 6 sectors, I should say, with the highest relative CAPE ratios are kicked out, leaving for the possible inclusion of the 5 most undervalued sectors. Those are the sectors with the lowest relative CAPE ratios. And then to those remaining 5 sectors, a momentum filter is applied to avoid a value trap. And that's where the sector with the lowest 12-month return on the total return basis is kicked out. And that's step 3, an important step there. And then what's left there is those 4 favored undervalued sectors with the most positive momentum. And these 4 sectors are equally weighted and held until the identification process of these is repeated again the following month. So ultimately what we're trying to do here, and what I should say, by we, I mean Shiller and Barclays, are trying to do is they're distilling this down into a sector rotation ETF that provides investors with exposures to those securities that correspond to these 4 sector that are cheapest based on this valuation metric within the U.S. large cap equity market. And those, especially with the most positive momentum over that period of time. So if you think about it, the economy as it stands today, if you think it's going to get weaker, if you think earnings are going to be weaker in these coming months, perhaps it's a process that using a process that kicks out these relatively overvalued sectors and looking for those that are undervalued. Something like that seems to make sense. And this is very straightforward. One of the things that we really like about it is its simplicity. It's an open kind of architecture process where we can get a glimpse into it. And at the end of the day, we really liked it because we thought there was elegance in this simplicity. And, as Sherman kind of alluded to this in the past, but, we've had, for those who are repeat listeners of our Smart Beta webcast there, they're going to recognize this process because it is consistent with this one that we use to obtain the U.S. equity exposure in the DoubleLine Shiller Enhanced CAPE mutual fund, which I'll be talking about in the next section. But for now, we'll be focusing on the new CAPE ETF. And I would say a key difference between the vehicles there is that with the ETF, you have U.S. equity exposure only via this process, whilst the mutual fund has exposure to both equities as well as the fixed income, similar to what Sherman just talked about with the multi-asset trend fund there. You have this idea of double value, two distinct sources of returns through one vehicle. So on this slide here, I have these relative CAPE ratios for each one of the 11 sectors plotted over time back to September of 2002. And you can see that the relative cheapness and richness across these sectors really changes and changes hand over time. It's a dense chart, and I know it's a lot of squiggles here, but if you focus your eyes on the far right, you'll see that we have the sector names ordered by the relative CAPE ratio as of March 2023, the most current point that we have available. And here you can see that the energy sector has been massively overvalued relative to history, peaking out at what appears to be a ratio that is off the charts. It looks like it's just slightly above the last number there on the left side vertical axis of 3.7. And if that truly is the case, again, that's off the charts rich at some point back a few months ago. But the remainder of these relative CAPE ratios across the other sectors seem to be hovering around the ratio of 1. So if you recall that relative CAPE ratio formula, if you get something on 1, a ratio of 1, sorry, that's basically saying that the metric, the ratio for that particular sector is at fair value. It's just equal to its 20-year historical average. By the same token, less than 1 means that something's going to be undervalued, and it's possible that it might represent something that's more attractive to be invested in. So let's, instead of looking at energy, let's look at the bottom 5 names here, as these have the lowest relative CAPE ratios as of March. We've got tech, we've got consumer discretionary, there's financials, real estate, and communication services. And for that period, communication services was kicked out of the inclusion into the index because it did have the worst 12-month total return momentum. That's that value trap filter in the process, step 3. So in March, the fund was allocated to the securities that correspond to the remaining 4 most favored sectors at roughly equal weights. Here, we could take a look at the historical allocation among sectors over time. You can see that the index has rotated through all 11 sectors going back to the inception of the index in 2002. But since we launched DSEEKS, the mutual fund that I'll be talking about next again, but since we launched that mutual fund back in October of 2013, you see that the mutual fund has had an allocation to every sector of the 11 except for utilities. And when I look at it from the start date of the launch of CAPE, which was March 31, 2022, I see that we've rotated amongst 8 sectors of the 11 there. So it's just getting started, it seems, through that active rotation across all sectors there. But securities for the CAPE index, I looked it up earlier, securities in the energy, utilities, and industrial sectors haven't been in the ETF yet. And if you look back, hopefully this works out. If you look back, yeah, you can see there on the right side, energy, utilities, and industrials are the richest sectors. Again, these fluctuate over time, but it seems to have been the case over the past 12 months or so. So you kind of have to squint your eyes there as you're looking at it, but I apologize for that. But let's move on to portfolio characteristics there. And what we have here shows the ETF fund positioning as of February 28th, 2023. These do tend to be a little bit lagged given the nature of the type of methodology and active investment that we're doing within the ETF. We do offer these on a delayed basis rather than a daily basis. But on the bottom left here, you can see the 4 sectors that I mentioned earlier with an allocation of roughly equal weights from the starting point of when they're first initiated into those sectors and the underlying securities to where they've drifted over the course of the month before the process is rinsed and repeated again. So these allocations, again, are subject to change monthly, but each month there will be 4 sectors with a weight that start out at 25% a pop. So when you look at that table there, you can compare it to the weights of the 11 sectors that underlie the S&P 500. And you'll notice that outside of technology, which has a weight of roughly 25% of the index, that's the highest allocation weight within the S&P 500. So that's a quarter of the index there. So outside of tech, any sector allocation within the CAPE ETF is going to represent an overweight relative to the S&P 500. And that's really an expression of the favored sectors, again, using that CAPE valuation methodology to determine favorable sectors and securities within the broader large cap U.S. equity market. And this lends itself well, I think, to the underlying names too, because you can see here, and I cherry picked a few of these earlier, but if you take a look at Amazon, the largest holding in CAPE, this sits within the discretionary sector, that's at 5.8%. And then when you look at it relative to the S&P 500, it's 2.5% within the S&P 500. So it's kind of in line with that 25 allocation weight in discretionary through the ETF versus the 10% plus weighting within the S&P 500. And then finally, one thing I'll point out here is you can see the trading statistics. If you're interested in these, unlike the allocations, are updated on a daily basis. So if that's your thing that gets you interested, it's updated daily on our website. You can also email us at etfinfo@doubleline.com if you're looking for more information on that, or if you're looking to put some money into work into this ETF. etfinfo@doubleline.com. So here we have a short time period, but it's the period since we launched March of last year of the performance of the ETF. And you can see we've had a little bit of underperformance to the S&P 500. And unfortunately for both the benchmark and the fund have had negative returns over this period. And if you recall the date, March 31st, that's just shortly, maybe 2 weeks after liftoff from the Fed when they came off of the zero lower bound rate. So, I mean, right now, I do think that time will tell. I do think that the potential for outperformance here over the longer term is pretty strong, though. So with that, I'm going to shift gears, and that brings us to the DoubleLine Shiller Enhanced CAPE Mutual Fund. I bring this up, and when I think about it, we do have a longer data set here since we launched this fund nearly 10 years ago now, October 31st, 2013. But with that track record, one could take a look at that and get a sense on the equity portion side from the access that we get through the CAPE index or U.S. equity market. It's possible that one could get a sense of the type of outperformance that the CAPE ETF could offer in the longer run. So switching these gears here, we have the structure of the DoubleLine Shiller Enhanced CAPE Mutual Fund. I was joking with this with Sherman earlier. It's like, even though it does say distinct in the second word of the body that you see here, you'll see that it's the same overlay structure that Sherman went over earlier with the multi-asset trend fund. The difference, of course, is that the fund gets access to the Barclays, the Shiller Barclays CAPE U.S. sector index instead of that multi-asset trend index offered by BNP. But both of these are entered into via a unfunded swap. So Sherman talked about it before, but I'll just highlight it again briefly. Every dollar you put into the fund, you get $1 of notional exposure to the index, as you see on the bottom right-hand leg of this two-legged stool. And because we enter the swaps on an unfunded basis, we can take your dollar and invest it in an actively managed fixed income portfolio. And that's something that we refer to as the double value proposition. Something that I did point out earlier when I was talking about the CAPE ETF, and I think it bears repeating here, is that a big difference between this fund and the CAPE ETF is that you're getting the enhancement of an actively managed fixed income portfolio through this mutual fund. And that's something you won't get in the ETF. Also, since we use the swap in this mutual fund versus buying the actual securities within the ETF, that's also another difference. You're getting the index return here versus with the swap, because you're using the swap versus kind of approximating the index return when we're buying the actively, when we're actively purchasing those actual underlying securities within the ETF. So I talked about the double value proposition, and it's here on the slide. And we call it this because as an investor, you do get access to two distinct sources of return that are both rooted in basically shifting exposures to the cheapest sectors of their respective markets. So with the equity market, you're getting the sector rotations to the cheapest sectors out of the CAPE process. And with the fixed income side, you're getting the DoubleLine practice or process of active management and shifting through and to sectors based on relative value. So ultimately, you get two distinct sources of value for two very distinct markets here. So I covered the methodology for the equity side now of the double value proposition when I went through the ETF. I'm not going to repeat it here. That's why I'm going to be able to skip right instead to the performance of the Shiller Barclays CAPE index that this methodology is based on. So this is the index exposure we obtained via the unfunded swap. This does not include the fixed income portion here. So it's one part of the double value proposition. You can call it a single value proposition for this particular slide. And you can see this goes back to the inception date of October 31st, 2013. And here we have an annualized outperformance on the CAPE total return index relative to the S&P 500 by 70 basis points. The annualized vol is slightly higher, you can see, but with it, you do get the slightly better reward to risk ratio as well. So when you're taking on this additional risk, you're getting rewarded, through that performance there. And I also point out that despite just being allocated to the 4 cheapest sectors of the U.S. large cap equity market and not all 11, you can see that the CAPE index still moves a lot like the S&P 500, albeit with this better risk-adjusted performance over time since 2013. And again, this is just the index performance, single value proposition. So this is really what I was talking about earlier. This can help give a sense perhaps of where the CAPE ETF performance over the long run seeks to approximate. So this relative outperformance to the S&P is something I and the team would expect the CAPE ETF to kind of look like over time. Next here, we have the second part of the double value proposition. Again, this is through the DoubleLine actively managed fixed income portfolio, the enhancement that you receive through the mutual fund. And the goal here is to outperform the cash rate, as Sherman mentioned before. It's represented by the 1-month LIBOR. That's the lower line in the chart. And if you look at the table, it's the right end of the table there. So we look at LIBOR because that would be the rate we would get if we entered into a fully funded swap. But since we think we are decent and to pretty good at managing fixed income, we chose to enter these swaps on an unfunded basis, and we use that dollar, put it to work, by through the fund structure and investing that dollar in that actively managed portfolio of fixed income securities. And ultimately, again, the output is that we're trying to outperform cash here. And you can see that we've added value over that, with an annualized return of 2% on the fixed income portfolio. That's more than double the cash rate over that same period, which is pretty darn good. As Sherman, mentioned before, last year was a pretty tough year, and you have to consider that LIBOR doesn't go negative during those years. So when you compare, when you look at that blue line, it's just flat, or sorry, not the blue line, I guess you can call it the goldish line there. It's flat to positive, but you compare that to the blue line, which is the DoubleLine fixed income performance. It dropped during the pandemic. That induced a sell-off in practically every asset class. And then again in 2022, where all financial assets had a negative sign in front of it for the calendar year performance. But through our active management, we were able to manage the portfolio out of that pandemic hole and then some. And then 2022 rolled around. It's a little bit early yet, but the first 3 months of this year has been quite strong for performance. And I think that the forward-looking return prospect of fixed income looks quite attractive here. So pretty optimistic there. And now this is the double value proposition. You combine these two, those two distinct sectors, sources, I should say, of return to give you the fund performance, what you see here. And these are net of fees, net of expenses on the institutional share class of that mutual fund, DSEEX, that you see on the top in the title there. So a little bit over 30 basis points of 30 basis points or so of outperformance to investors per annum. Slightly higher volatility, but you do have similar Sharpe ratios there. And I mentioned before, I think the forward-looking prospects of the fixed income portfolio look quite strong. I think the silver lining that we had to the sell-off in rates last year is that we are near decade-level highs in yield across most fixed incomes. You see that the duration stands at 1.3 years, and it takes on low credit risk. I mean, the credit we hold here were bought with the idea that they should be money good, over time. And this portfolio on it as a whole, at the portfolio level, it's rated single A. You can see that roughly 75% of the securities are rated either government or government guaranteed or IG. So breaking out the composition of the portfolio, we have about a quarter of the portfolio sits in US T-bills. We'd like to maintain this part of the portfolio around this level at any given time, because this is what potentially does serve as margin for unrealized losses when there are unrealized losses within the swaps that we hold. And today, I mean, that's not too bad to hold T-bills. I mean, again, you're actually seeing yields that are higher than the rest of the curve, and the yield today in the north of 4%. So we do like to keep this T-bill portion pretty steady on hand to have that cushion. The rest of the portfolio composition changes over time. It's reflective of our view on markets. You can see that CLOs is the biggest piece after T-bills, and the overwhelming majority of that's going to be rated AAA. I think there's a few out there that are rated AA, but the bulk of it is going to be AAA. And conversely, when you take a look at the right-hand side there, we do have below investment grade, and those typically reside within the bank loans. But as Sherman said, it was nice to have some of that in 2022, given the floating rate aspect. But the rest of the below investment grade is a smattering that's spread across the other credit sectors. So just over 9%, it looks like, below investment grade. The unrated category here on the right side, again, that might be a little bit of a head scratcher, but it's exactly as it sounds. These are securities where the issuer chose to not obtain a rating from the major credit rating agencies. It's really reserved for those who are experienced enough. Those shops are experienced enough to underwrite and actually do credit work themselves. And you get a complexity premium for these unrated securities, and they're typically seen in the securitized sectors of the fixed income market. So your non-agency MBS, your non-agency CMBS, and your ABS there. But one thing that I always stress is that just because they're unrated doesn't mean that they're closet below investment grade securities, or that doesn't mean they're investment grade either. It just means that they are unrated. And when I think about it, it's I was reading this while Sherman was going through his slides. If you pull out your magnifying glass and it says the same thing here, and read the footnotes at the bottom, it talks about the credit quality there of particular securities or groups of securities that doesn't ensure the stability or safety of that overall portfolio. But I was thinking that that's a disclaimer that our compliance team forces upon our materials, but guess what? They're right. It's why we do our own due diligence on every single CUSIP that underlies every single portfolio that we run here at DoubleLine, regardless of it's unrated or has a below investment grade stamp on it, or if it's perceived to be investment grade by the credit agencies. We do our own work, underwrite it as we see fit, and only buy things that we think are we're getting rewarded for the risk, because you can't rely on the agencies to get it right. I mean, they failed miserably in 2008, and you can't trust them. So with that little rant, actually, I don't know why I got off on that tangent. I am going to get off my soapbox. So that wraps up the U.S. equity offerings there. CAPE for, the CAPE ETF for those who are looking for a smarter way to access the large cap equity market. If they have a preference for ETF vehicles, then investors can look for that CAPE ETF. The Shiller Enhanced CAPE that I just talked about earlier for the mutual fund, it's for those who want that double value proposition for that same methodology of a better way to access the equity market, but with the enhancement of that actively managed fixed income portfolio. And again, that one comes in the mutual fund wrapper. So now we're going to jump across the pond so we can talk about the DoubleLine Shiller Enhanced International CAPE Mutual Fund. And the fund name itself is a little bit misleading here. You'll see eventually as I go through the slides that this is a European equity product, but the regulators imposed their will. And so we have international in the name here. I am going to move at a faster pace because much of the process and portfolio is going to be similar in concept to what we just covered, but applied to a different equity market here. So let's start by looking at the valuations. And I've got the CAPE ratio for both the US and the European markets. Europe is in red. And you can see that not only does it have a lower CAPE ratio than the US, it's roughly 20 versus 29 on the US there, but the current CAPE also looks to be lower, at the lower end of the range, at least going back to 1986. And if I were to eyeball it and guesstimate, I would say that it looks like it's going to be below average as well. So from that standpoint, Europe looks relatively cheap, whereas on the eyeballs, again, the US at 29 looks to be about average there. And here we have the slide that pits, or actually that puts MSCI Europe Index relative to the US, and that's represented here by the S&P. And you can see that in the legend, we're dividing the European index by the US index to get this relative indicator. So as the line moves down into the right, that means the S&P is outperforming Europe, the MSCI Europe index. And really, if you take a look at it, that's been the case since the GFC. We're just about to the bottom there, it looks like, of the range in 2022 when you got a little pop. But since then, it looks like Europe may be beginning a trend of outperformance here. And you've seen a couple of head fakes along the way since that GFC downtrend. But based on on this metric and by looking at the CAPE ratios that I just showed on a previous slide, Europe does seem to offer a cheaper alternative and a way to get exposure relative to the S&P 500. Here, looking at the structure again, you're going to see that same distinct structure that we used across the three mutual funds now that we're talking about today. Same concept of getting $2 for every $1 of investment into the fund. One thing that I'll stress is that this is not financial leverage. We're not borrowing to get that additional dollar of exposure. And again, it's available because of the unfunded swap that we're entering into that's fully collateralized by that fixed income portfolio that we put the dollar into as the investment. So again, that's how you get that double value proposition, which I covered. Here we have the country exposure. And for those who are interested, we've got the equity exposure across 15 developed market countries in the MSCI Europe Index. And these countries are listed at the bottom: Austria, Belgium, Denmark, Finland, France, Germany, Ireland, Netherlands, Norway, Portugal, Spain, Sweden, Switzerland, and to wrap it all up, the United Kingdom of Great Britain and Northern Ireland is within the represented through that index. Here are the sector selection rules for the international CAPE. I will go through it a bit because in spirit, it's the same as the CAPE index rules that I went through for both the CAPE U.S. Equities ETF and the Shiller Enhanced CAPE Mutual Fund, but there are some differences here. One of the differences is that it's the Europe sectors, and those are the 10 that are listed here on the right. And because of the availability of the data, the index, as you can see in step 1, can only examine 24 years of data, or 292 months to be precise. That's based on the asterisk footer that you see on the bottom. So there you can see that also on the first step of the process on the chart on that flow chart on the left there. But with each new month, that count goes up from that 292 to eventually being able to match the other CAPE index by capturing a rolling period of 360 months for that step 1 process. Outside of that, it's the same as what we just went through in the earlier slides. Here you can see the 5 cheapest sectors as of the most current period. It looks like they're materials, consumer discretionary, healthcare, communication services, and staples. I looked it up earlier, and materials was kicked out for having the worst momentum there. So that didn't pass the falling knife test there. Historical allocations for the European index, and you can see similar to the U.S. CAPE index, this index has had exposure to every single sector of the market going back since the inception of the index, and really since the launch of this mutual fund. The fund has rotated in and out of every sector based on whatever screens rich and whatever seems cheap each month, kicking out the rich, keeping the cheap and more favored sectors. So all 3 of these funds that we've talked about today, both the CAPE ETF as well as the 2 mutual funds, they have been actively rotating amongst the most undervalued sectors of their respective markets. And as a result, you can see here that the index has performed quite well since we launched it back in December 23rd of 2016. It's outperformed the MSCI Europe index by about 1.5% per annum there, and it does so with a lower standard deviation. You can see the higher Sharpe ratio here as well again. So again, you're getting kind of the similar wiggles and jiggles that you saw with the longer term look when we were looking at the US CAPE index there. So again, you're getting that positive correlation to the market, albeit with better performance. And ideally, that's what you should be looking for in a smart beta type of product there. You're trying to get that market exposure. So when it comes to the fixed income portfolio, that's the other leg, again, of that double value proposition. You can see a similar type of performance that we had in the US version of the mutual fund. And that's really to be expected as ultimately, again, that the 3 mutual funds use this structure and try to maintain that kind of same thematic view on the fixed income portfolio. So by the 3 mutual funds, again, I mean the Multi-Asset Trend Fund, the US mutual fund, and the the International CAPE mutual fund there. So again, International CAPE, the Shiller International Enhanced CAPE Fund there, not for clarity. So all 3 of these mutual funds that we talked about today have that kind of thematically similar makeup in their fixed income portfolios. So as one would expect, you're getting a similar type of performance where we have that added, where we, meaning DoubleLine, has provided that added value over the cash rate. Here you can see that it's a tune of about 40 basis points over the cash rate, 1-month LIBOR. Also, you can see that, again, we managed through that pandemic kind of meltdown back in 2020, and then we started to work our way through that downturn through the most recent hit to financial assets back in 2022. So combining these 2 sources turn together to deliver this double value proposition that gets you this mutual fund performance that you see on the page here. And with that, you can see that the fund is outperformed by 60 basis points annualized, with similar, slightly lower vol for a better risk-adjusted return. So far we've seen this consistency really of this outperformance using this better mousetrap that really begins with the Shiller's relative CAPE process, which identifies these relatively undervalued sectors to be invested in. Seeing that consistency there across not only the ETF, but also for the mutual funds. And with the mutual funds, you get that extended benefit of having that enhanced added value of the fixed income portfolio. So that's something that we refer to here as that takes great, less filling aspect of it. This will be the last slide before I hand it over to Sherman for the Q&A section. Again, this is going to look very similar, but I will just note that it is intentionally similar to what we just saw with the CAPE portfolio. Again, it's supposed to be thematically similar, and ultimately the positions ideally would line up very closely as well. So with that, at the portfolio level, you see similar low interest rate risk at the 1.3 years. And you also see about 3/4 of the portfolio in a combination of either investment grade rated securities or government sponsored or direct government investments into T-bills. So with that, that concludes our prepared remarks today. I wanted to thank everyone for tuning in. And with that, I'm going to pass it over to Sherman for the Q&A.
All right, Sam, and thanks for that, and thanks for everybody for sticking with us. I know these are long webcasts when we cover all these products, so we'll try to streamline them a little bit going forward too. But just jumping in the Q&A real quick, someone's asking about the mechanics of the swap and the cost. The cost is dependent upon the underlying index that you're trading, the replicability of it. Most of these swaps are put on to be long tenor. That is, they have a tenor that is greater than 1 year. So they are total return in nature. You can kind of strip out that funding spread back and forth. You can do it unfunded or not. But ultimately what happens is that we get the return of the index, less the financing costs, and then you add the return back of the fixed income portfolio to get the overall strategy cost in there too. So you can look at the SAI or the prospectus to see for each individual fund what the cost of each of those swaps are. So again, it's all disclosed in there as well, so you can look at that. Just given time and how many different ones we have in there, it's not going through the details there. Someone's asking for the history of the sector rotation. If you go back in there, what Sam covered, you can see there's a chart that shows the history of the index and it changes, but we do not publish that just given our licensing requirements on that as well. Someone's asking, are we buying mortgages being liquidated by Silicon Valley Bank and Silvergate? No, we haven't seen that yet. We've seen that BlackRock was hired to help sell those portfolios. So there was some concern in the marketplace that potentially an unexperienced manager would come in and fire sale that portfolio. But given it's BlackRock, we expect to be somewhat orderly. But this is also in the face of there being a reduction of the Fed's balance sheet where mortgages are rolling off, as well as where the Treasury is being sold in there. So it could put a little bit of pressure in terms of agency mortgage spreads. There has been a little bit of weakness in there since that crisis due to that kind of that perception in the marketplace. But we do have capacity to buy. We're willing to buy, but obviously at the right levels here. So that hasn't hit the market yet. We continue to monitor it. It makes this a very, very short term. We're kind of neutral on the mortgage basis. But once those bonds start to clear in the marketplace, we think that's a very attractive opportunity. So again, as an investor, you don't try to haggle over basis points here and there, but I think there could be a marginal impact to spreads, but not anything that's probably meaningful and observable to a normal market observer there. So someone's asking about how will CAPE behave when the PE compression or lower earnings. This is why you want to buy cheaper parts of the market. Obviously, lower earnings without a multiple, if the multiple doesn't expand, obviously brings the price down in general. But again, if you're focusing on parts of the market that tend to be cheaper, hopefully it kind of mitigates some of those effects as well. So again, like anything else, PE compression, it behaves very similarly, just the same thing, lower side of the earnings equation as well. Someone's saying the difference between buying swaps and underlying stocks. It's all about the tradability of the stocks. It's a rotation that's bid offer spread. We think that they're very comparable in nature. That's how we've assessed the ability to enter those swap contracts as well. And so to us, we think that those look very similar through a full cycle. Someone's asking the CAPE index perform relative to the S&P during a recession. Again, if it's the recession's driven by the higher flying names, you'd expect it to outperform. Right, if you're not exposed to those sectors of the market or the higher flying, and the CAPE process has been extremely active in its rotation over the last couple of years as well. And so again, it's behaving as we'd expected to see. We've seen rotation each and every month this year once again, and you'll likely see that again once we get the holdings at the end of April. You'll see what's happening within the portfolio again too. So there definitely is a lot of rotation going on there, and again, that's part of the reason for that monthly process of reassessing it. Someone's asking about what bucket would multi-asset trend fall into. We think of it as kind of like the alternative. I know the phrase liquid alts has been somewhat abused out there, but trend following is definitely something that it doesn't belong in your kind of equity bucket or your fixed income bucket because it encompasses multi-asset it traffics in both long and short positions. So I think of it as being something that's an alternative. And you can see even in a year like last year, you can see that it behaved just like that as well. And so someone's saying growth rates of earnings over the last 30 years. No, we don't have 30 years of data. If you actually read the footnote, there's about 24 years of data in there. And the reason for that is the introduction of the euro. So if you recall, the euro was introduced at the end of 1998. And so for consistency and not trying to map things over, you want to make sure that you have that basis. So the difference between the Eurozone and what we do in the US, the process is still, it's trying to get to 30 years. Once there is 30 years of data, which will happen in 2028, and believe me, it'll be here before you know it. It's funny how time flies, especially as we get older. But until that point in time, that window expands. And so when we first started this product about 6 years ago, we only had about 17 or 18 years of data. So that window expands until we get to 30, at which time it'll rotate. And so, when we first launched that product too, there was a lot of our clientele that said, well, how come this doesn't work as well as the US? And it's just different markets at different times. But you can see, and Sam illustrated that well today, that through the cycle, the international CAPE product has been able to also outperform its index as well. And so, someone's asking about the securities in CAPE trapped to the index return in the swap. They're extremely similar. That's what we're trying to do with the swap. So again, we'd expect to get similar rates of return there through that. And then again, someone's asking about overall asset allocation on the multi-asset trend. And with that too, you think about it as one of your kind of alternative exposures too. So I know a lot of people have private equity, private credit, use commodities in there as well. And so we think about it as something to, kind of increase that efficient frontier. You want it to zig when other things are zagging. I like that what Sam said today, the zigging and zagging. And so what the goal of building a portfolio is that it doesn't need to perform in every single environment. You need it to perform when other things aren't working as well. So again, I think if we go through the questions, someone's asking about a view on the yen. The yen does look cheap. I don't know if it's because of the new finance minister. It's cheap because obviously the differential in interest rates. And so we do believe that the yen would behave like a flight to quality asset once again, if there were some bad things happening. And if those bad things do indeed happen, it's likely that the Federal Reserve will have to cut U.S. interest rates, which is what's driving some of that, some of the weakness in the yen. And we think that could cause the yen to start to rally a little bit as well. So definitely thinking about the yen as a flight to quality trade also, not in any of these portfolios because again, the currency exposures are too volatile for what we're trying to put in these collateral portfolios as well. And so, again, I want to thank everyone for tuning in today. We promise next time to streamline a little bit better, get the story a little bit tighter in there so we don't spend a little bit over an hour on these webcasts. But as always, if you need anything from us at DoubleLine, please reach out to us, fundinfo@doubleline.com, for any information on these funds or anything else you need from the folks here at DoubleLine. Thanks again for tuning in. Have a great rest of your week this week, and best of luck as we go into CPI reports tomorrow. Take care all, and we'll speak soon.
Thank you. And that does conclude today's conference. We do thank you for your participation and have an excellent day.